Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Morning, team. Welcome to Finance Friday. Once again, I just want to start off with a quick finance joke. What do you call a dinosaur that's good with money? An investosaurus. Just a quick shout out to Kevin for joining us all the way from Florida. Good evening, Kevin. Today, actually, I want to have a conversation in regards to how much you can actually borrow. Now, obviously, when you approach your brokers, you always, the question I always get from my clients is how much can I actually borrow? And what it comes down to is there's actually two parts to it. Now, the first part to how much you can actually borrow is based on your affordability. And the second part is based on the security that you provide. So when we talk about affordability, it's based on your income or the expenses you have, credit cards, personal loans, any student debts, any buy now, pay later facilities. All those liabilities taken into account. If you've got existing loans and you're purchasing investment property, then all your loans are covered in there. If you're running a business, most lenders will look at all the loans within your business as well. And the other part that is looked at in the affordability section is your living expenses. So that pretty much, how that's covered from the lender's point of view is there are minimum living expenses, so just the mandatory ones that are included, and there are discretionary living expenses. So basically things that are above what the banks use. These include like private health insurance, private life insurance, private school fees. All those are actually added on top of the minimum living expense. So the banks use a figure called HEMS. And if you have expenses that are not classified within HEMS, then it is added on top. So you do get scenarios where your personal living expense can be $3,000, but the banks are using a higher living expense because of your income. And then say for example, they'll use 4,000, and then on top of that, if you've got private health insurance, childcare, private school fees, they add that on top of your minimum living expenses. So there is a lot of detail that goes into the banks working out your affordability, but that covers how much the banks are willing to lend to you based on how much you earn and what your living expenses are and your liabilities are. The second part to how much you can borrow is based on the property that you actually provide to the lender. And based on the security, the lenders can lend up to 80% without mortgage insurance, and then between 80 and 95, depending on the reason you're purchasing and also the lender. That usually incurs lender's mortgage insurance. Now, there are scenarios where my clients have had low affordability, but a lot of security and a ton of equity, but we can't access it because they just don't have the income to service it. And then you get the flip side where you can afford a higher loan, but the security you're providing to the lender is capping out how much you can actually borrow. So those are the two factors, and they are looked at separately, and whichever one is lower means that, whichever one lower is how much you can actually end up borrowing. We've got a couple of questions. Mike asks, if I can cancel my credit card 6 months prior to taking out a loan, does it give me enough time to rebuild my credit score? Specifically on that question, I don't actually believe that it makes that much of a difference in regards to your credit score. It will obviously help when it comes to how much you can actually borrow. But I've had scenarios with my clients where we've worked out how much they can borrow, and part of that requires them to close down their credit cards or reduce their credit card limit. But we've actually conditioned that with the banks. So it means that you don't actually have to close out the credit card if they're not willing to approve the loan for you. And so that the lenders will come back and say, okay, happy to lend you the money. You need to provide us a letter that the credit card's limit is reduced or closed, either prior to formal approval, or we've even done it prior to loan settlements. But again, I don't think 6 months is enough time to have a huge impact on your credit score. Tim's asked, people complain because they can afford to pay higher rents, but the banks will say no to a loan, which would be a lower figure than paying rent. Look, absolutely. I mean, there's a lot of situations. I've had clients where we've looked at their living expenses and it's way lower than what the banks are using. And I think this situation here, Tim, is around how banks look at your living expenses and how they judge that, as opposed to actually looking at people's actual living expenses and using that. Again, different cultures obviously live differently, and I've had clients who we can generally show that their living expenses are a lot lower than HEMS and what the banks are using, yet at the same time, the banks are using twice the living expense. And I think that's probably where, your comment in regards to paying higher rent and then taking out a loan that's actually lower doesn't actually make sense. And I totally agree with that. There are a couple of tips that I would like to share with everybody. When you're taking out your mortgage and you're going through your budget, use calculate the loan repayments based on either a 2 or 3%, depending on what you're comfortable with, 2 or 3% above the current rate that you're actually being offered. Okay, lenders already factor this in, but when you do it yourself within your own personal budget, you're actually buffering it in so that should the interest rate actually increase, then you're able to already meet those commitments and it's already factored into your budget. What a suggestion I would make is when you've got your home loan and you've got an offset account, you can ask your lender to create a second offset account, and you can put that additional repayment based on the 2 and 3% higher into like a savings account. That's your just in case account, and potentially if rates don't change much over the next couple of years, you'll actually be increasing your savings, and you could potentially use that to look at an investment property or to be able to throw that money into your home loan so that you're actually paying off your home loan quicker. Another tip that I have noticed with my clients specifically is the importance of actually talking to having a finance strategy conversation. The way I look at that is how we can actually sequence loans. And I'll just give you an example. One of my clients, one of my team's clients who we've just met, they've recently taken out a cash flow loan against their business. So a cash flow loan is basically lending against the business cash flow and not using any other security. Because it's unsecured, the loan term that they're currently being provided is really short. So it's a 4-year loan term and the interest rates are really high. Now, these facilities are great if you need cash really quickly and there's an opportunity that's available that you need to take up. The conversation that needs to be had is that how do you get yourself out of those loans? Because there usually is a way. It may take 6 to 12 months, but there needs to be a plan move out of that. Now, this particular client, we can look at them and see what their asset position is. We've actually got lenders who will, like big commercial lenders, who will actually look at being able to lend up to 100% against the client's residential home, and actually just use the business financials if that works. So that's a tremendous policy, but that's an opportunity for a client to go say like a 22% loan down to like a 7% loan over a 30-year period. Now we don't actually need to do the numbers, but you can imagine the impact of that in terms of the cash flow personally, but as well as for the business. Loans don't actually have to run for the full term. So taking a loan out, even the loan for the 3 to 4 years, it doesn't actually have to run for the 3 or 4 years. Most of the time, when it's a variable loan, you can move out of it without incurring a huge penalty, or there may be a fee to actually cancel the facility, and that could be only a couple of $100, but the savings you have would be in the tens of thousands. So my tip is that the next time you actually have a conversation with your brokers, ask them about the strategy in regards to your loan. So once you've actually got the loan, ask them, okay, now that I've got the loan, what are we doing? Are we looking to pay off this loan sooner? If this is an investment loan, are we looking to review this after the interest-only period? Like, there has to be conversations about what we're doing after the loan, and not just having the loan set and then you being, okay, what do I do now? Am I just leaving this, or are we taking steps to ensuring that this loan is actually the right loan for me at this particular time, but going forward into the future as well. Thanks for joining me today. I'd love you to like and subscribe to this channel, and have a great weekend.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.